Alright everyone, I want to talk about the bonds section of your asset allocation. The bond market is much bigger than the equities market, and I've listed several of the different subcategories, as many as I could fit on the whiteboard, but this is just an overview. It goes into a lot more depth than this, but this is a good starting place. So let's jump in. So first we have mortgage-backed bonds. So if you recall the 2007-2008 crisis that led to the Great Recession, that was largely caused by these crazy instruments that stemmed from basically mortgage-backed bonds. What a mortgage-backed bond is essentially, imagine your mortgage. I don't have a mortgage, but if I had a mortgage, all these people that are taking out mortgages on homes, banks essentially pull all those mortgages together and then slice it up into little pieces and sell them to investors. So investors are essentially, when you're paying your mortgage payment, there's investors all over the world that are entitled to those cash flows, or that are making money from your mortgage. Huge sector of the bond market. Next we have corporates. Now there's really two main categories or subcategories in corporate bonds. We have investment grade bonds and we have high yield bonds, commonly also known as junk bonds. So really the main difference between these two are their credit worthiness. There are rating agencies out there, for example like Moody's, that rates the overall credit worthiness of companies, similarly to how individuals have a credit score. So anything, and I'm going to do a video on bond ratings also, but essentially anything that is between AAA all the way down to BBB is going to be considered investment grade bonds. Those are categorized by companies that are more likely to pay you back for lending them money. And in return, the higher credit rating you have, the lower interest rate you'll have. High yield or junk bonds are going to be bonds that are below BBB, so BB all the way down into the C's. And I'm not really sure if your rating's below a C, you're already bankrupt. The rating agencies usually go down to C. Those are going to be categorized by companies that maybe they don't have as good of a credit history, maybe they've fallen on hard times, their balance sheet is not really looking as promising. Basically, the likelihood of you getting your money back is less than, say, a AAA rated company. So you're going to be rewarded for that. By lending them money, you're going to have a higher interest rate or a higher yield on the money that you've invested out. But you also have a higher chance of losing your money because that company could default. Next we have municipal bonds. So municipals are a very widely used and loved asset class, especially for elderly folks that are higher net worth that want cash flow. One of the main attractive features of municipal bonds is that they are tax-free instruments. So that means you don't have to pay taxes on the cash flows that you're getting from that investment. So municipals, you can think of any local government as an example. Fulton County, which is the county of Atlanta, or Orange County in California, and everything in between. These counties will fund different projects. Maybe it's making new roads, or putting in new sewer systems, or making a new park. Just you imagine it. Local governments borrow money to pay for these, and then they tax people to pay the bonds back over time, and those are called municipal bonds. Next, we have treasuries. Treasuries are you've probably heard how much debt the U.S. government is in. That is in the form of treasuries. So treasuries are characterized as the most risk-free, if there's a such thing. The closest to risk-free that you can get is a U.S. Treasury bond. That is also commonly considered the baseline for interest rates. So as Treasury yields or Treasury interest rates rise and fall, so too does the rest of the bond market. It kind of fluctuates with the Treasury yields. Right now, the 30-year Treasury bond is hovering around, I looked last night, around 2.83%. And this is the largest debt offerings that you're going to see. The U.S. government commonly issues new bonds to pay for old bonds that are rolling off and to pay for deficits that the federal government has. And other governments like China, Saudi Arabia, Japan buy these, and also large hedge funds, large private equity firms also participate in buying treasuries. Fascinating market and incredibly complicated. It seems kind of simple, but fascinating and complicated market. Next we have bank loans. So bank loans are the most common form of debt financing for individuals and companies. And they're categorized, essentially I'm trying to say this in layman's terms, they have the first, they get first claims on assets in the event of default. And that's also important to note for bonds in general. Bond investors have a higher claim to assets than equity holders. So they get paid out first, and then if there's anything left over in the event of a bankruptcy or something, all bondholders get paid out, and then if there's anything left, then equity holders get it. But bank loans are the most common form of financing for small companies all over the country. Next we have international bonds. So international bonds, U.S. investors have the option to, like you would invest in bonds for Apple or Microsoft or any company that issues bonds, you also have the option to invest in international company bonds. And these can be denominated in US dollars, they can be denominated in other currencies, maybe the local currency. And then you also have established kind of developed market bonds, maybe Germany or the UK or Japan, or you might invest in emerging market bonds, maybe Argentina, Brazil, South Africa, Indonesia. That might be more considered a frontier market. But there's tons of different options to invest in international bonds all over the world. Next we have TIPS. So these are protected. So TIPS are Treasury inflation protected securities. So what that essentially means is that you are protected from interest rates rising and falling. And this gets a little complicated, so I'm going to try to explain it as simply as possible. But the price of bonds and interest rates have an inverse relationship. So if I issue a bond and interest rates then go up, all of a sudden new bonds that are being issued are more attractive to investors because they can get a higher interest rate. So that makes the price, if I sold $1,000 worth of bonds at 5% interest, and then now the interest rate that you can get out there is 7%, well, all of a sudden whoever bought my bond at 5%, that's less attractive because now other investors can go get bonds at a higher rate. And so if that person who I sold the bonds to tries to sell it to someone else, they're going to have the price that people are willing to pay for those bonds is going to be lower, because another investor is going to say, wait a second, why would I buy, this bond at 5% when I can go buy bonds at 7% and make more money? So that's why interest rates and bond prices have an inverse relationship. And TIPS, or inflation protected bonds, are basically the interest rate is moving along with inflation. So investors are more protected in the event of interest rate changes, which is why some people find them attractive. Anyways, this is, like I said, not all of the subcategories of bonds, but this is a good overview, and I think a good starting place. We'll get into more detail later, but I think this covers a lot of the different main subcategories of the bond market.